Let me tell you about my friend Alex. He's a pretty typical guy, works hard, and always tries to do the right thing. He's not a risk taker by nature, and he's always been pretty responsible when it comes to his finances. Alex was always careful with money, sticking to safe investments like mutual funds and bonds. He diligently reviewed his bank statements, made sure to save a portion of each paycheck, and generally followed the conventional wisdom when it came to building wealth. He believed in slow and steady growth, prioritizing security over the potential for quick riches. But everywhere he turned, work, the break room chatter, even casual conversations, social media, with its endless stream of curated success stories, YouTube. People were bragging about a new crypto coin, a digital asset promising astronomical returns. Influencers were touting its potential, and ordinary people were sharing screenshots of their overnight gains. The price kept climbing, seemingly defying gravity and all traditional financial logic. Each day brought new record highs, fueling the frenzy and attracting even more attention. Alex did the math. If he'd bought in early, even with a small amount, he could have made a fortune. He started running different scenarios, calculating potential profits and imagining the possibilities. The more he crunched the numbers, the more enticing the opportunity seemed. The fear of missing out grew, gnawing at him with each passing day. He started to question his conservative approach, wondering if he was being too cautious and letting a life-changing opportunity slip through his fingers. One day, after hearing a coworker celebrate huge gains, practically shouting with excitement as he showed off his phone screen, Alex caved. The peer pressure, combined with the allure of quick wealth, finally broke his resolve. He downloaded a crypto app, lured in by the promise of easy trading and instant access to the market. He put in his vacation savings, the money he'd carefully set aside for a well-deserved break, thinking he could quickly double it and still have plenty of time to plan his trip, and bought at the peak, just as the market was about to take a sharp turn. For a few days he felt like he was finally in the game, a part of something exciting and potentially life-changing. He imagined himself as a savvy investor, finally reaping the rewards he deserved. He checked his phone constantly, refreshing the app every few minutes to see how much his investment had grown, dreaming of what he'd do with the profits, picturing exotic vacations, a new car, and maybe even early retirement. But he wasn't investing in technology. He was chasing a feeling, a fleeting sense of excitement and the illusion of control. This is how so many people get into crypto, drawn in by the hype and the promise of easy money. Not through research, careful planning, or a deep understanding of the underlying technology, but through emotion, pure and simple. The excitement, the thrill of potentially striking it rich, the hype, the constant barrage of positive news and success stories, the sense of being left out, the fear of missing the boat. It's a powerful force, capable of overriding even the most rational judgment. Alex's story isn't unique. It's a common tale repeated countless times in the world of crypto and beyond. It's the story of countless first-time investors, lured in by the promise of quick riches and the fear of being left behind. They're not driven by deep understanding, careful analysis, or a long-term investment strategy, but by the rush of joining in, the allure of easy money, and the fear of missing out. And often, that rush leads them to buy at exactly the wrong time, at the peak of the market, just before the inevitable crash. The crypto market feeds on these emotions, exploiting the human tendency to follow the crowd and to act impulsively when faced with the prospect of quick gains. And that's where the real story begins, the story of what happens after the initial excitement fades and the market turns against them. What Alex felt was classic FOMO, that unsettling feeling, the nagging thought that everyone else is in on something big and you're being left behind. It's a powerful force, especially in the fast-moving world of crypto. The fear of missing out. It's a primal instinct, amplified by social media and the constant barrage of success stories. When everyone around you seems to be getting rich, posting their gains and celebrating their wins, it's hard not to jump in, to chase that same feeling of success and financial freedom. The pressure can be immense. In crypto, FOMO spreads fast, fueled by viral trends and online communities. A coin rises, seemingly out of nowhere, people talk, sharing their excitement and potential profits, news outlets amplify, broadcasting the story to a wider audience, and suddenly everyone wants in, creating a frenzy of buying activity. The hype feeds on itself, creating a self-fulfilling prophecy of price increases, driving prices higher and higher, seemingly without end. But FOMO usually means you're late to the party, arriving just as the music stops. Early investors profit handsomely, having bought in before the hype began. Latecomers buy at the top, often just before the inevitable correction. The urge to join is strong, almost irresistible in the heat of the moment, but it's a psychological trap designed to lure you in at the most dangerous time. FOMO isn't a signal to invest. It's not a reliable indicator of a good opportunity. It's a warning that emotions are running high, clouding your judgment and leading you to make impulsive decisions. Recognizing this can save you from costly mistakes, protecting your capital from unnecessary risk. In crypto, understanding your own psychology, your biases, and your emotional triggers is as important as understanding the market, the technology, and the underlying fundamentals. It's about finding balance. Herd mentality is just as powerful as FOMO. When everyone's buying, it feels safe to follow. In crypto, value is often based on belief, not fundamentals. The crowd's excitement can drive prices up for no real reason, but the herd can turn fast. Panic selling can follow just as quickly. The same group that drove prices up can send them crashing down. Ask yourself, is the crowd right or just following itself? Don't let the stampede decide for you. The world of investing can be exhilarating, filled with the promise of substantial gains. Excitement can quickly turn to fear in an instant, especially when the market takes an unexpected turn. The rapid pace of change can leave even seasoned investors feeling vulnerable. After Alex, full of optimism, bought in, the market, volatile as ever, dropped sharply. The initial excitement quickly faded as the numbers turned against him. Watching his hard-earned savings shrink before his eyes, panic began to set in, a feeling familiar to many who've faced market downturns. The urge to sell, to cut losses, and stop the pain became overwhelming, a siren song promising immediate relief. Panic selling spreads fast, a contagious reaction fueled by fear and uncertainty. One person sells, triggering a chain reaction as others follow suit, and prices plummet, accelerating the downward spiral. Most who succumb to panic selling ultimately lock in their losses, solidifying a negative outcome. At the worst possible moment, missing out on any potential rebound. They miss the inevitable recovery, often left with deep regret and a sense of missed opportunity. The emotional roller coaster of investing can be brutal, testing your resolve and mental fortitude. The key to navigating these turbulent waters is to have a well-thought-out plan before you even begin to invest a single dollar. Stick to that plan, even when fear inevitably takes over and clouds your judgment. Don't let short-term panic and market fluctuations ruin your carefully considered long-term financial goals. Discipline, patience, and a long-term perspective are your best defenses against the emotional pitfalls of investing. Social media and non-stop news drive crypto's wild swings. A single tweet or viral post can send prices soaring or crashing in minutes. Hype spreads instantly, amplifying both excitement and fear. Bots and influencers can manipulate sentiment, creating fake buzz. The pressure to act fast is intense. Many investors get caught up making impulsive decisions. The constant noise is exhausting and dangerous. Don't trust every headline or trending topic. Take a step back before you react. So how do you survive the crypto roller coaster? First, never invest more than you can afford to lose. Have a plan. Know why you're buying, your goals, and when you'll sell. Write it down. Refer to it when emotions run high. Use dollar-cost averaging. Invest small amounts regularly, not all at once. This smooths out volatility and keeps emotions in check. Limit your exposure to the noise. Don't check prices constantly. Focus on the long term, not daily swings. Build a system that protects you from your own impulses. In crypto, discipline beats hype every time.